A strict double top resembles the capital letter M. It ends an uptrend with a range defined by two downswing points with one minor upswing point in between them. Once the market moves under the minor upswing defining the temporary lower boundary, an accelerated downtrend tends to form. Later, if the market trades back up to the double top range, there is usually increased resistance due to remaining selling pressure. High volume can appear at one or more of the swing points. It is a preferred but not necessary feature, especially since it doesn't always appear. Most volume tends to concentrate around the break of the lower boundary, defined by the minor upswing. The reverse applies for a double bottom during the bullish reversal of a downtrend, as it resembles the outline of the capital letter W. Double tops and double bottoms can also form when a second major swing point forms in line with a previous one but don't form the characteristic W or M shapes. Movement in between the two major swing points is spread out and not concentrated in a temporary range, and can result in smaller reversals or less reliable analysis of large reversals. That is why they can be called less strict or spread out double tops and double bottoms. Triple tops and bottoms present the same general features as double tops and bottoms, but their ranges encompass an extra downswing and upswing. Like the double top and double bottom, the triple top and triple bottom can also be less strict or spread out, and not necessarily concentrated in a clearly defined horizontal range. It is also important to remember double tops, double bottoms, and triple bottoms won't always have their swing points perfectly aligned. It is acceptable to have some slight deviation, as long as the candles that form the swing points cover the same approximate price range. When there are more than 3 upswings or downswings, these patterns can turn into flat tops or flat bottoms. When these patterns fail, they can become part of a resting phase in a continuation formation, showing the general price action of a 3 methods rising or 3 methods falling candle pattern. The head and shoulders pattern gets its name due to resembling a head and shoulders. This is in part why it is a common and effective chart pattern. Humans simply have a tendency to be drawn to formations that resemble human features, especially symmetrical ones. It summarizes a gradual transition of an uptrend to a downtrend. This bearish reversal accelerates once the neckline range is broken to have price trading under the 2 minor upswings that were part of the shoulders. The head and shoulders doesn't necessarily have to be symmetrical, just as long as the downswings that form the shoulders are lower than the middle downswing point, that is the head. So the shoulder line formed by the left and right downswings don't always form completely horizontally aligned. The same is true for the neckline with the 2 upswings. Skewed or slanted head and shoulders can be highly dynamic, easy to analyze in some cases, and difficult to discern in others. Like the triple and double top patterns, the head and shoulders highlights an important resistance range. Trend lines from the head and shoulders can also be highly useful. Most often it will be a downtrend line from the downswing points of the head and right shoulder. There is also a counterpart, the reverse head and shoulders, That is also called the inverse head and shoulders. However, it can be difficult to recognize and analyze even though it is literally the head and shoulders pattern, except it is upside down to summarize the gradual transition from a downtrend to an uptrend. Ascending triangles combine an uptrend line with a horizontal resistance area. It is preferable the resistance area have at least 2 downswing points to reference, though it is acceptable to only have 1, especially in cases where there is only 1 downswing point to reference at new record highs. This formation is more likely to continue an existing uptrend upon breaking above the resistance area. When it is found in a sideways range or a downtrend, it is not so reliable. Failure of an ascending triangle can lead to a double or triple top, or just a simple downward reversal. A descending triangle applies all the concepts and features of an ascending triangle, but in the reverse, to continue an existing downtrend under a defined support range. Preferably, the support range has at least 2 upswing points to reference. Using only 1 upswing point is acceptable to define the support range if only one exists, such as when a chart reaches new record lows.